Hey, what's up guys? Welcome to another episode of Real Life CFA. Today we're going to talk about Collateralized Loan Obligation, aka CLO. So by definition, a collateralized loan obligation is a single security backed by a pool of corporate loans with low credit rating, or loan taken out by private equity firms to conduct leverage buyout. What it means is that CLO is just a bunch of high-risk business loans, similar to CDO, which is Collateralized Debt Obligation. So this is how it works. Let's say IronHawk goes to the bank, wants to borrow $1 million to expand its business. IronHawk is a startup company, meaning the loan is kind of risky. The bank says, okay, fine, I'll lend you $1 million. And I'm going to pack this $1 million loan into a CLO and sell the CLO to the investor. In this way, I can eliminate the credit risk on this loan and I can get back the principals right away. So there's no risk for the bank after selling the CLO because now the investors owns the $1 million loan to IronHawk. But on the surface, IronHawk still pays the bank interest and principal payments, but the bank will redirect these payments to the investors. Sounds familiar, right? Yes, it works exactly the same as a CDO. So this is the structure of a CLO. Same as CDO, it's divided into tranches. And each tranche would have a different credit rating, meaning a different level of risk. All cash flows that goes into the CLO will satisfy the need for the higher tranches first, and then it flows down to lower tranches, meaning the lower tranches will have a higher probability of default than the higher tranches. And these tranches can be sold separately, and each tranche would have a different yield to maturity because they have a different level of risk. So this is the headline back in August 2021. Saying that the global CLO market hits $1 trillion milestone. So the market is growing rapidly. Is it a good thing? Yes and no. On the positive side, CLO really gives banks the ability to lend out to small business or risky business to help them to grow. But on the negative side, similar to what happened in 2008, if banks get too greedy on these products, the banks will slowly lower their standard of risk management on CLO because once they've sold this loan to investors, they bear no risk at all. And at the same time, they get back their principals and lend out to more businesses. Is this going to be another bubble like 2008? I'm not sure. Maybe not. Because financial institutions, governments, regulators, and investors now have the experience of 2008. So when treating the risk of CLO, they have something to refer to. Unlike in 2008, the risk of CDOs were too complicated to understand by most people. But now it's different. So I hope the CLO market won't grow into a bubble like 2008. But if the Wall Street gets too greedy, things can get bad. This is a brief introduction to Collateralized Loan Obligation. I hope you like it. Please don't forget to subscribe and like this video. Thank you very much for watching, and I'll see you next time.